Welcome everybody to the first edition of the Rainey Review for 2026. This slide shows the growth of $1 invested in various asset classes for the 3 months ended 31 December 2025. The leader this quarter is emerging markets shares in red, where $1 invested 3 months ago would have grown to $1.05. In second place is unhedged international shares in navy, where $1 invested 3 months ago would have grown to $1.04. Crowded in a flat and somewhat anemic looking middle is that 50-50 mix of shares in property and cash and fixed interest, where $1 invested would have grown to $1.01. A modest start, but that's on the back of a rip-roaring September 2025 quarter. This slide shows the growth of $1 invested in those same asset classes now over the 12 months ended 31 December 2025. The leader, again, is emerging market shares in red, where $1 invested 12 months ago would have grown to $1.30. In second place, also again, is unhedged international shares in navy, where $1 invested 12 months ago would have grown to $1.18. Middle of that now unambiguously positive pack is that 50-50 mix of shares in property and cash and fixed interest, where $1 invested 12 months ago would have grown to $1.09. That's a pretty good year. But I always say 1 year is not long enough. We need to look at least 3 years' data. This slide shows the growth of $1 invested in those same asset classes now over the 3 years ended 31 December 2025. This time, the leader in a scarcely credible $1.96 at the end of 3 years is unhedged international shares in navy. In second place is emerging market shares in red, where $1 invested 3 years ago would have grown to $1.70. In third place, in Australian gold, is Australian shares, where $1 invested 3 years ago would have grown to $1.49. Standing out in the middle is that 50-50 mix of shares in property and cash and fixed interest, where $1 invested 3 years ago would have grown to $1.32. That's a very good 3 years. Against my better judgment, I want to talk about New Year's resolutions. It's against my better judgment because I don't believe in New Year's resolutions. If something's important enough to change, you should do it immediately, not wait for some arbitrary date in the future. This is one of the reasons that my colleagues sometimes think I'm a robot. I'm not a robot, but that's what robot me would say. Anyway, this year I was swayed by reading a post from a colleague I admire in Australia. David Andrew, who founded Capital Partners in Perth, writes the tremendous newsletter The Purposeful Investor. In his first newsletter of the year, David leaned into the data, that's how he got me, to help frame how we should deal with the sometimes scary world of investing. This slide shows a scatterplot of the calendar year returns of the S&P 500 market, that's the largest share market of the United States, from 1928 to 2005. The data behind this chart is updated annually by Professor Aswath Damodaran of New York University's Stern School. The blue dots are the calendar year returns in US dollars, and the red line is the average annual compound return, which turns out to be 10.03% per annum. There's a lot that's interesting about this chart. The range, that's the difference between the lowest and highest returns, is very wide. Negative 43.84% in 1931 to positive 52.56% in 1954. That's 96.4%, or more than 9 times the average return. Another interesting point is that the average line of 10.03% in red was only touched 3 times in all 98 observations. Nothing clever, no stock picking, no market timing, just boring buy and hold and discipline. That means ignoring the devastation of a negative 43% in 1931 and the euphoric rise of 52% in 1954. Doing that earned investors 10.03% per annum, almost for doing nothing. To put that in perspective, $100 of the S&P 500 in 1928, with all dividends reinvested, would be worth approximately $1.157 million today. That's great. But other than newborns, no investor's time horizon is 98 years. So what about over 25 years? Crazily, the results are even better. The average 25-year return, some were better and some were worse, over that whole time period was 10.46% per annum. Again, to put that in perspective, $100 invested for 25 years at an average return of 10.46% per annum would be worth $1,202 today. Sure, it's not 1.157 million, but it is 12 times the initial investment. The problem is, to earn that return, we have to endure the volatility that characterises the market. Market risk is the price we pay to earn the returns that the markets offer. Over this 98-year time period, the S&P 500 delivered a negative return in 26 of those calendar years, approximately 1 in 4. That's uncomfortable. 6 of those negative years were worse than negative 20%. One of them, 1931, was worse than negative 40%. Investors are notorious for not earning the market return over time. Typically, this is due to behaviour. Selling when nervous, buying when euphoric, or sitting on the sidelines waiting for the right time to invest. All of which can be devastating to your wealth. The evidence is clear. The market offers the average return. Only investors can decide whether or not they'll earn it. One of the best ways to do so is to have a plan and stick to it. So, for those of you that do believe in New Year's resolutions, I suggest David's one. Commit to a long-term plan, understand the maths of compounding, and refuse to let temporary market setbacks derail your long-term plan. Thank you all for watching. I look forward to updating you again in the next edition of the Rainey Review.